Let's zero in on oil and the equity markets. We're joined by Kevin Headland, Co-Chief Investment Strategist at Manulife Investments. Kevin, thanks very much. Hard to know where to begin. Such a fast-moving story. But are you surprised to see that oil has cooled its jets a bit?
Good morning, Andy. And I'm not too surprised, actually, given the narrative coming out of the U.S. administration. It seems like the markets and oil is really pricing itself off of the headline news and whatever comes from the administration. Obviously, the market wants to move higher. Any positive news tends to move it higher. We're seeing material intraday volatility in the markets. It starts lower, it moves higher, it comes back lower, finishes the day higher. It's hard to see the whipsawing effect of the markets on a day-to-day basis, given what's going on in the Middle East.
And you say across in history, across a wide range of geopolitical investments, terrorist incidents, wars, markets usually bounce back.
They do. And I think when we look at geopolitical events, obviously there's many over the history of the equity markets. The key is for us is really looking to determine whether these events are disruptive or destructive. And when I mean destructive, I mean more impacting to recessions. Do they lead into recessions? And that is the big issue, which tends to lead to prolonged bear markets in the equity markets. And what you've seen so far over history is it doesn't lead to recessions typically on average. So usually you get a bottoming of the US S&P 500 roughly 14 days after the initial day starting the geopolitical risk. And then you actually see recovery on average 40 days later. And with 1 year, returns tend to be positive. So the key really is the longevity of the conflict of geopolitical risk, and of course, whether it does lead to economic malaise leading to recession.
Sorry, I don't want to quibble, but was it 19 days that the market tends to bottom or 14? I mean, I'm quibbling and it's not a precise science.
I thought my data had about 19 days, but it could be 14. We're definitely quibbling over days. It all depends on your calculations of when it starts and when it ends, for sure.
For sure, yeah. It's not an exact science in that sense, but 2 or 3 weeks anyway, let's call it that. And yeah, sorry to be nitpicking.
Not at all.
And often we find that a year after the event, returns have been positive. The market's higher.
On average, they tend to be higher, yes, especially when we don't lead into recession. So there's a few times when we look at the Yom Kippur War of the early 70s, you have the 9/11 terrorist attacks. They actually were either the catalyst or just happened to be one of the factors that led to recessions. And of course, when you're in recessions, that's when markets tend to be still negative 1 year in advance. So the key really is determining, will that lead to recession? Now, of course, any geopolitical risk affecting oil prices tends to be a main issue when it looks at recession risks, because oil is a major factor in consumption. Higher oil prices tend to lead to higher costs for companies and also higher costs for consumers when it translates to gas prices. So this is a material issue, especially for the U.S. right now. Higher gas prices, could it erode some of the positivity that we've seen in the economic environment in the U.S. So far this year?
Are you and your team tempted to go into longer term bonds? Because we have seen something of a sell-off in those amid inflation concerns.
Well, that's really the interesting aspect, because typically long-term, especially U.S. Treasuries, 10-year U.S. Treasuries, tend to be safe havens in this type of environment. However, as you said, what happens with higher oil prices, it is now worry of inflation. And even the market has repriced in the expectation of central bank rate cuts in the U.S. as well around the world, or even perhaps rate hikes in Europe. So that is a risk with inflation. So when we look at bonds, we have to be very, very mindful about where we want to be in the treasury curve. Perhaps we want to be mid-duration or even hiding out in the short duration and almost cash-like short-term bonds to try and ride out this uncertainty.
What about energy stocks? Are you overweight them right now? If you could generalize, you run so many different portfolios.
On average, our teams tend to be right now neutral energy stocks, especially in the U.S., especially in Canada, excuse me. There is a wide range of types of investments we look at on the energy side, whether it's pipelines, producers or explorers, E&P. So it really depends on the individual company. But on broad base, we tend to be neutral. There's opportunities definitely exist here. And of course, we've been waiting for that catalyst for oil prices to jump, and that tends to help energy prices. But again, is this a temporary jump or more structural and long-term in nature?
Is there any group that you are overweight or underweight right now in terms of equities?
Yeah, I think broadly speaking, we're looking in infrastructure, industrials. Even before this event, we were liking this aspect of the markets, especially in the U.S., kind of dialing back a little bit of the risk levels. So a lot of the areas that have been performing quite well, there's nothing wrong with taking profits and readjusting to other areas, and not necessarily going deep value, but just looking to be more diversified across different businesses and sectors.
Leave us with a final thought. We have, just to return to the theme we touched on at the top, we have seen this movie before, haven't we? Rapid reaction in markets, and then things tend to settle down. For one thing, oil as a way of persistently flowing onto global markets, one way or another.
There's a lot of levers to pull, as the Trump administration is talking about, looking at, as you said, releasing some strategic reserves, looking at taking care of the Strait of Hormuz and making sure there's battleships that stay with the big oil tankers. So there's a lot of opportunity to make sure that oil flows to the areas needed. So that's important. I think when you look at overall from an investment perspective, it's key that throughout these events, even what we saw last year of Liberation Day, not just geopolitical, but other headline leading events, that we look past the short term, make sure that we have a well-balanced approach to investments, make sure that the investor keeps on their financial plan, and not to make knee-jerk reactions based on any type of headline news.
Thank you very much, Kevin.
My pleasure.
Kevin Headland, co-chief investment strategist at Manulife Investments.